Good morning, Cam Brewer for Cam's Mortgage Minute for Thursday, September 13th. Well, we've all looked at the positive side of low interest rates, and today I thought we'd look at the downside of low interest rates. That's right, low interest rates are not a winner for some of the folks out there, and they're not thrilled about them. Particularly when it comes to pension funds, money market funds, shareholders in life insurance companies, and even banks themselves. They are not exactly really thrilled about this environment. And if you look at what the Federal Reserve and the Bank of Canada is really saying with low interest rates, they're basically, it amounts to a subsidy for borrowers at the expense of savers, because savers are getting virtually no return and the borrowers are getting basically a bonanza in record low interest rates. And it doesn't look like these rates are going to change anytime soon, because the Federal Reserve has indicated that it looks like it won't be till 2015 they can conceivably see some uptick in the rates and what's going to happen to them. So how do life insurance companies and banks adversely get impacted by this? Well, banks make money, as you know, on the difference between what they pay depositors and what they earn on loans, known as net interest rate loan margins. Bank margins back in 2007 were about 4.5%, when the 5-year Government of Canada bonds were yielding around 4.2%. So that's not that long ago. Currently, bond yields are around 1.5%, and the average net interest margins of the bank are around 2.55% in the second quarter. Now, those are drastically lower numbers. Basically, in the bank margin return, we're talking almost half, and on the bond side, it's greater than a half drop in there. So we're talking really record lows. Now, life insurance companies are harmed by low rates because they need income from their investments to pay future obligations to policyholders and those receiving annuities. If rates are too low, basically profits suffer. Pension funds are also hit really hard with this because they have to meet the obligations of retirees, and their assets need to average anywhere between 7 to 8% a year, and that's really very hard to do when 10-year government bonds are yielding less than 2%. So they either have to look at more risky investments or try to sell off some assets or try to do some other creative things. So there is indeed some losers with low interest rate environment. We only look at the upside when we're in the mortgage business. Of course, we're dealing with the borrowers, and for them, like I said, it's a great time. But when we look at all the other folks impacted by this, there is a larger impact. And while none of us may be thrilled that banks make profits and that we don't have any issue with bank yields dropping, at some point they will be forced to raise it because the profit margins just aren't going to be palatable anymore. And of course, we all need the insurance companies to make sure they can pay when it comes time to pay. And any kind of pension fund, well, hey, any of those that are retirees are looking for consistent checks. How long will this low interest rate environment exist? You know, the Feds, the Bank of Canada is signaling longer. Some economists are saying shorter. Not quite sure, but I think there will be a fine equilibrium where the ouch factor for the savers is going to outweigh what the benefits to the borrowers are. So when that day comes, we will finally see rates starting to move. Anyway, it's been Cam for Cam's Mortgage Minute, and I will see you tomorrow.